Hey there, welcome back to Finance Focused, the channel where we make financial topics easy to understand and help you take control of your money. Whether you're saving for retirement, investing for the first time, or just curious about the stock market, we've got you covered. If you're new here, don't forget to subscribe and hit that notification bell so you never miss out on our weekly content. And if you find this video helpful, give it a thumbs up. It really helps our channel grow and reach more people like you. Today we're diving into the basics of the stock market, what stocks, bonds, and ETFs are, and how each one can play a role in your investment strategy. Whether you're a beginner or just looking to brush up on the basics, by the end of this video, you'll have a solid understanding of these key financial instruments and how they fit into your financial future. So let's get started and demystify the stock market together. Let's begin with stocks. So what exactly is a stock? Well, think of it as a little piece of a company. When you buy a stock, you're essentially buying a small ownership stake in that company. It's like getting a slice of a pizza when the whole company is the pizza itself. As a part owner, you get to experience the ups and downs of the company. But why do companies even sell stocks? It's pretty simple. They need money to grow. Instead of borrowing funds from a bank, they can sell shares or stocks to investors like you. And in return, you have the opportunity to benefit from the future success of the company. So by investing in stocks, you become a part of the company's journey toward growth and prosperity. Imagine you decide to invest in one share of Apple. As Apple continues to expand and sell more products, the value of that stock has the potential to rise. In some cases, companies like Apple distribute dividends, which are a portion of their profits given to shareholders. However, not all companies follow this practice. Some opt to reinvest their profits back into the business to fuel further growth. The main takeaway is, stocks are considered high-risk, high-reward investments. If the company thrives, the price of your stock could surge. Conversely, if the company encounters difficulties, the value of your stock might drop. That's why it's crucial to choose stocks diligently and adopt a long-term perspective. When you invest in stocks, you are essentially placing a bet on the success of the company. Introducing bonds, the lending side of the investment world. Unlike stocks that involve ownership, buying a bond means you are giving a loan to a company or government, receiving regular interest payments in return. So how do bonds function? When a government or company requires funds for a project, such as building infrastructure or launching a new product, they issue bonds. As an investor, you purchase a bond and lend them money. In exchange, they agree to reimburse you with interest over a specified period. It's similar to earning interest on your savings account. But bonds often offer higher returns due to the slight increase in risk compared to simply depositing your money in a bank. Let's consider the US government as an example. Suppose they issue a bond to finance a highway project. You buy that bond for $1, and the government agrees to pay you back with a 3% interest rate over 10 years. Each year you'll receive interest payments, and at the end of the term, you'll receive your initial investment. Bonds are generally perceived as safer than stocks because they provide a steady and predictable income. However, this safety comes with lower returns. Bonds are particularly suitable for individuals seeking stability in their investments, especially those approaching retirement. Introducing ETFs, the answer to diversifying your investments with utmost ease. Exchange-traded funds are highly popular among investors because they offer the best of both worlds, the diversification and convenience. But what exactly is an ETF? Think of it as a basket full of different investment options, such as stocks and bonds, all bundled together. When you invest in an ETF, you're essentially owning a portion of each investment in that basket. So instead of purchasing individual stocks from numerous companies, why not buy an ETF that holds shares from all those companies? It's a brilliant strategy to diversify your portfolio without requiring a large sum of money or expert knowledge. For instance, let's say you have an interest in the technology industry, but don't want the hassle of picking individual tech stocks. No worries. Simply invest in an ETF dedicated to tracking the tech sector. This ETF will contain stocks from renowned companies like Apple, Microsoft, and Google. granting you exposure to the entire industry through just a single purchase. One of the most remarkable advantages of ETFs is their ability to diversify risk. By spreading your investments across multiple assets, you avoid the risk of putting all your eggs in one basket. Unlike mutual funds, which can only be traded at the end of the day, ETFs trade just like stocks. This means you have the freedom to buy and sell them throughout the day, offering you unparalleled flexibility and control over your investments. In summary, ETFs offer a convenient and diverse investment option, making them a popular choice among investors. Don't limit yourself to individual stocks when you can easily own a piece of the entire market through ETFs. Start maximizing your investment potential today. Are you unsure about which investment option is right for you? Well, let's explore the differences between stocks, bonds, and ETFs to help you make an informed decision. If you're seeking long-term growth and are willing to take on more risk, stocks might be the right choice for you. By entering the market, you have the potential to earn higher rewards, but do keep in mind that you'll also be exposed to market fluctuations. On the other hand, if stability and predictable income are what you prioritize, bonds may be the better option. These investments offer a reliable income stream and are ideal for those who are closer to retirement or simply prefer a lower level of risk. Now, if you're looking for a middle ground, ETFs might be the perfect fit. These investment vehicles provide diversification, spreading out your risks across multiple assets. This makes them a fantastic option for beginner investors or those who want exposure to various assets without the hassle of buying individual stocks or bonds. Ultimately, the right investment strategy depends on your unique financial goals and timeline. Are you saving for something long-term, like retirement? Or do you prefer to generate income now? A well-balanced portfolio often includes a mix of stocks, bonds, and ETFs to suit different goals. So take your time to assess your financial objectives, risk tolerance, and timeline before diving into the world of investments. With a clear understanding of your goals, you'll be better equipped to choose between stocks, bonds, and ETFs and build a successful investment strategy that aligns with your needs. Are you feeling unsure about the stock market? Don't worry, with a little knowledge and a solid plan, you can overcome the intimidation. Understand what you're investing in and why, and consider your risk tolerance and long-term goals. Remember, investing is about steady growth, not getting rich quick. Patience and consistency are key in the stock market. And that's it for today's video on Finance Focused. We hope this breakdown helps you feel more confident about getting started with your investments. If you enjoyed this video, give it a thumbs up. And if you have any questions, leave them in the comments below. Be sure to subscribe for more financial tips and strategies to help you achieve your goals. Thanks for watching. And remember, stay financially focused.